Good afternoon, everyone. On behalf of the Global Interdependence Center, welcome to today's executive briefing. I'm Holly Wade, GIC's Vice Chair of Programs, and today we are pleased to welcome Dr. Loretta Mester, President of the Federal Reserve Bank of Cleveland. Dr. Mester is a longtime friend of the Global Interdependence Center, having participated in our programming around the world, including our central banking series events in Paris, Dublin, and Singapore. Thank you for joining me today for a conversation on the U.S. economy. As we enter the second quarter of 2024, I thought we would start off with just a basic overview of what your thoughts are on how the economy appears to be performing well, what your outlook is for this second quarter.
Well, thanks, Holly. I really want to appreciate you moderating today and having the conversation. I also want to thank the GIC. It's a great organization. I've been very happy to be able to participate in many of your programs, both internationally and domestically. I think the economy and policy are in a good monetary policy are in a good place right now. We've seen sort of early in the year stronger economic data and perhaps stronger employment data. I'm sure we'll talk more about the data that's come in. And so my view is, I had been thinking that last December when we had FOMC forecast, I had penciled in that I thought growth this year would be a little bit below trend. But given the information we've received, I now think growth this year will be a bit above trend, and my estimate of trend is 2%. But I do think that we're seeing moderating demand on the demand side of the economy, partly because interest rates have been raised and we're in a restrictive policy stance. But labor markets have remained healthy and stronger, overall employment growth than many had expected. The unemployment rate is very low, so that's a very solid performance on the real side of the economy. At the same time, we've seen inflation coming down. Partly that's because demand is moderating, but a lot of that improvement in inflation also can be attributed to what's happened on the supply side of the economy. So, last year and the year before, we saw some progress on, getting rid of some of those impediments on the supply side in terms of supply chains, bottlenecks, those have been normalizing. We're not back to where it was pre-pandemic, but those have been moderating, getting into better balance. And then we've also seen people re-enter the labor force. So the supply of labor has gone up, again, a normalization, if you will, given how many people left the labor force during the pandemic. And we've also seen recently revised data that shows that immigration was also higher than we thought. So there's been in sort of normalization in the labor market as supply and demand have gotten to better balance. We've also seen on the product side, improvement on the supply side and better balance there. And that have contributed to this improvement in the inflation front. So we're not there yet. We're not back to 2% inflation, which, as you know, is our goal. But we are making good progress on that. I do expect that progress to continue over time and getting back to 2%. I don't think the pace of disinflation this year will match what we saw last year, which was a very strong pace, partly because I think, we're going to have to rely more on the demand side for the rebalancing than on the supply side, given that we've normalized some of the labor market supply and also the product market supply. But I have that kind of good outlook that things are going to continue along the path that we're on now, and that we will be in a position later in the year as we gain more confidence that inflation is coming down and will be on that sustainable 2% path to begin easing off of the restrictive policy that we have. And I do anticipate if the economy evolves as expected, we'll be in a position to actually begin lowering the Fed funds rate.
So as you mentioned, inflation has decelerated off of its peak quite a bit, but it still remains elevated above the 2% target. But growth is solid. The labor market looks to be in good shape. And given all of these conditions combined, why is the Fed projecting to begin lowering interest rates this year?
Yeah, well, I can talk about the way I view things. And of course, we're talking about the most likely scenario, right? You always have to be understanding that, you know, the economy could evolve differently than you anticipate, and you have to be prepared to update your views on the economy as more information comes in. So you're right to point out that, you know, we have a relatively solid growth forecast and a relatively solid labor forecast and actual statistics on those. The early readings on inflation this year came in a bit firmer than many had expected. And that's why it raises sort of, we really need more evidence that inflation is moving down. But if we gain that confidence and see more data that inflation is indeed, you know, moving down, I mean, it's not going to be one for one. It's every month, you know, there's going to be some volatility there. But if it's moving down on that sustainable pace to 2%, then I think we should be thinking about moving rates down, because if inflation keeps moving down and inflation expectations keep moving down, holding nominal interest rates at the same level is essentially an unintended, I would say, tightening in policy, because real rates would be higher. So as inflation and inflation expectations move down, at some point, you're going to want to ease off some of the restrictive policy. At the same time, we have to be very cognizant of what's going on both sides of our mandate. So I always, you know, in the early days when we started raising rates, we were really focused on inflation. We had to, you know, bring inflation down. Labor markets were strong. Inflation was the problem. Now we're in a position where we're not back to 2% yet, but we've made progress, and we're in a position now where we're balancing the risk to both sides of our mandate. And I think that's going to be the challenge going forward, is doing that appropriate balancing. And I don't think it's appropriate to lower rates yet. We need to have more evidence that inflation is on that sustainable downward path to 2%. But when we gain that confidence, then I think it would be appropriate to move rates down. And if the economy evolves as I anticipate, then I think we will be in a position to do that later in the year.
So speaking of the confidence that inflation will continue down its kind of downward trajectory, what gives you confidence that inflation is sustainably on that path of the 2% target? And are you confident that inflation's target should remain 2%? Is that the appropriate target?
Well, 2% is the target, and I think it's the appropriate target. So that's the easy part. You know, I would need to see more data. I want to see a couple more months data to actually, you know, be, you know, able to sort of discern, are the early readings this year that we've gotten, are they signaling that disinflation process is stalling out, which would be concerning, and which would actually tell you, well, you're going to have to hold interest rates at the current level for longer than in the baseline? Or, right, are we going to, with the more data, see that, yeah, those were sort of that bumpy road back to 2% inflation we've been talking about, and that really isn't the trend. Inflation is actually starting to move back down. I never anticipated this year we'd see the same pace of disinflation that we saw last year, again, because I think we had a lot of help from the supply side last year, and it's hard for me to see that we'll have as much help from that side because of the improvements that have already been made there. But I did anticipate that we'll see inflation moving down, and now we need to see more evidence that confirms that. And once I see that, then again, I think we're in a position to move interest rates down. But as you also pointed out, there's risks around any forecast, and there are risks to the economy, and that's why we need to sort of see more evidence to raise our confidence level before we're prepared to take that first step.
How low do you think rates will go? Is the long-term neutral rate higher than it has been in the past? Or do you think that rates will move back down to levels seen during the pandemic?
Well, it's a good question. In fact, in the latest summary of economic projections, which are the projections that participants on the FOMC put in 4 times a year, so we just did one in March, I raised my estimate of the nominal Fed funds rate over the long run to 3%. I had been for a long time at 2.5%. And the reason I did that is for two reasons. One, because it does appear that the economy has been more robust despite the high level of nominal rates that are in the economy. And also, if you look at estimates of the so-called equilibrium real interest rate, R star, those estimates across models have been moving up. And so based on those two inputs, I decided it was time for me to raise my longer run Fed funds rate. So I don't think we're going to see interest rates go back down to the very low levels we saw pre-pandemic. And I think, that's one of that persuaded me that, it was time to actually change my projections on that. Of course, every time you change your projection, you're thinking about, okay, is this the right time to do it or not? And I typically don't like to change very quickly these longer run structural aspects of my forecast, but I got to the point where I thought it was appropriate to raise mine up about to 3%, so up 0.5 percentage point.
So one of the areas that's been of focus and heartburn for a lot of folks having to absorb higher costs related to housing. What is your outlook for housing? And we also had a few questions that were submitted early, and I want to thank all of those who submitted questions beforehand. And if you have questions throughout this conversation, please submit them in the Q&A, and we will hopefully get to yours in the latter half of this conversation. But we also had a few questions that were submitted early related to how you expect shelter to contribute to inflation. Is there a chance that shelter inflation, if it doesn't cool, will prevent overall inflation from getting back to 2%? But more generally, what is your outlook on the housing inflation front?
Right. So in the inflation measures, of course, it's not the cost, it's not like the asset price of a house, right? It's the housing services part of it. So the way I look at inflation, we've been sort of looking at housing as an important component, of course, in everyone's consumption basket. Also sort of core services, ex housing, that's a very important part of the basket of what people buy, and then goods prices. And I think we need to see more progress on the housing front and also on core services in order to get back to 2% inflation. Now, if you look at rents in new leases, so that's data that we actually track here at the Cleveland Fed quite a bit and have models on that. Those have come down quite a bit, and those are pointing to further disinflation in the housing services component of inflation. So my outlook is that we'll see that happen, but we're going to need to see that happen. Again, we want to see those components that have been stickier beginning to move back down and continuing to move down. And that'll be an important part of the forecast going forward. Similarly with services, core services, also, we need to see that continue to move back, the inflation in those continue to move down. And that's kind of the path back to 2% inflation. So in other words, think about more as supply and demand imbalances get into better balance so that those are smaller, we're going to see, I think, inflation move back down. But we need to see that, and we need to see that happening. And we're not there yet.
So with a lot of the data that we've seen lately, and especially last year, that were really positive, good GDP growth, especially the last half of last year was terrific. But the mood in the US public still seems to be pretty downcast as far as how they feel. And what do you think about that? And how do you interpret the pessimism, even though it's improved a bit, but the general pessimism with the US public with economic data and how they're feeling?
So it's an excellent question. You're right. In the latest surveys, there seems to be a bit more improvement in sentiment and about the economy. But the general statement you made, I think, is correct. So a couple of things. And we actually had a Business Advisory Council meeting here in Cleveland this morning. And this was a topic of conversation about sort of how are people feeling about the economy and the disconnect, perhaps. I think a couple of things. One, if you actually look at the cumulative increase in prices since, April of 2021, when things really started, when inflation started picking up, we know wages have gone up, but the increase in wages over that time have not yet gotten to the same level as the prices have gone up. So there's been a narrowing in the gap as wages have continued to rise and prices have started, or inflation has started moving back down, but it hasn't been enough to close that gap. And for people with lower incomes, the gap is larger. So again, they haven't really made up for the fact, in their wages, for the fact that they're having to pay higher prices. So that's one reason. As the discussion today at our bank pointed to, is it's also, if you think about the average person, starting a new job, it's very difficult for them to purchase a house, those big purchases now. And so when they're thinking about, talking to their parents, where were you in the same stage of life that I am now? There's a feeling they're not as well off as their parents were at the same stage. And I think that's also something that, or even like some of our business contacts were saying, even if you want to buy a nice car, it's harder. So these big sort of salient purchases that people make, it's a little harder now for people to do that. And I think that also may be weighing, at least our business advisors said, they think that's weighing on sort of the psyche. And just the other thing that's weighing on everyone, and I feel this way, I'm sure a lot of us do, there's just been a lot of change, right, that we've gone through, if you think back, right, and a lot of difficult circumstances. When the pandemic first hit, the forecasts, there were really dire predictions about how the economy would fare. Thankfully, we got through that period. But I think just the rapid pace of change around us and what we lived through is also weighing on people, and rightfully so, because those were very challenging times. On the good side, things are improving, not for every group at the same pace, but you see it across, income groups and other ways you slice the data, improvement.
Yes, it does feel like folks are feeling a little less uncomfortable, maybe not good. We haven't gotten to that side, but a little less uncomfortable than they were before. But looking at the labor market, how would changes in the labor market affect your view on, your dual mandate? That is, if employment continued to be strong, would that make you want to hold off on lowering rates? Or if job growth slowed significantly, would that alone be enough for you to want to bring lowering rates, even if inflation remains elevated?
So I think the strength of the labor market is a good thing. I don't read that as necessarily predicting that, we're going to have inflation is going to pick up again. Because we've seen this ability to have inflation come down and significantly come down, even with a strong labor market. And that's been a distinguishing and real remarkable thing about this cycle, right? This economy. And I think it's attributed to the fact that this period of time, right, the supply side played a significant role here in how the economy fared since the pandemic. It was a lot of supply side changes, and typically we don't see that kind of change on the supply side. Much of a business cycle is sort of driven by the demand side. So we've seen disinflation happen even with a strong labor market. So having a strong labor market, I think, is a good thing. And that would not lead me to think, we're going to see inflation coming back up. It's the balance between supply and demand that might be predictive of, where inflation is going, not one side versus the other. That said, when we started to tighten policy, we had to rightfully really focus on the inflation part of the mandate, partly because we weren't well positioned, right? Inflation was moving up, and persistently so, and our policy rate was extremely low. So we had to move rates up at a pretty aggressive pace. Right now, with inflation where it is and with the labor market where it is, right, we're in a good spot, right, to be able to react either way. You know, if the labor market, and this is not my baseline, but if it were to deteriorate significantly, we have policy position that we can address that and we can move rates down more swiftly and sooner than in our baseline forecast. And so that we're in a good position. On the other hand, if it turns out that inflation is hanging up there and stalling and not on that sustainable path down, given where labor market conditions are, they're still strong, we would basically be able to wait until inflation moves back down and hold a little longer than the baseline in terms of our policy rate. So we're well positioned, but you're right, we've got to balance both sides of the mandate now. And I think that's going to be the challenge of policy going forward. It's really that balancing between both parts of our mandate, because both parts are in play right now, given where the economy is and given where our policy is.
So speaking of waiting a bit, if that is the scenario, in delaying, say, the initial cuts to the later part of the year, if the data doesn't come back to support them, worried we would be going into an election season come this fall. How does the Fed navigate that this period when its moves might be seen as influencing the outcome in November? Is that a concern?
So I've been going to FOMC meetings a long time. I've been president here 10 years, but before that, I was a research director at the Philly Fed. So I've been able to attend many, many FOMC meetings, and I have never seen politics, the political situation, play a role in the meetings, right? We really come in there with our information we've gathered from all the contacts we talk to in our districts about what's happening in our regions and our views about, okay, what are the implications for the national economy? And we come in and set policy to achieve and to promote our dual mandate goals. And that's what drives sort of the decisions around the table in terms of the monetary policy decisions we make. So I don't take that into account at all. And I think the history of the FOMC shows that, we take action as action is required, or inaction as inaction is required, independent of the political situation. And that's what's the beauty of the setup of the Fed is, right? The way the Fed was structured in this decentralized central bank fashion and having the independence to set monetary policy away from the political situation is a strength of the setup of the institution.
Switching gears a bit, the Fed has been slowly letting assets run off its balance sheet, so-called quantitative tightening. The Fed has indicated it will soon begin slowing the pace of runoff. How soon, and what factors will you be considering in making that decision going forward?
Well, you're exactly right. The chair talked about that at the most recent press conference that we had a discussion about, began discussing reducing the pace of runoff in the balance sheet. And a little bit of background, right? We've been, since June of 2022, we've been allowing the Treasury securities that mature and our agency mortgage-backed securities to run off the balance sheet at a fairly good clip. And, we're following the plan that we announced in May of 2022. So it's a deliberate runoff, consistent strategy. The holdings of securities on our balance sheet are about $7 trillion. They've declined because of the runoff plan, about $1.4 trillion. We have overnight RRPs, reverse repo balances, which again are ways that they're a signal of liquidity. So, right, they're now under 600 billion. The last data point I looked at was March 27, but they've been coming down, and in fact, they've been coming down, and reserves have not come down yet. So, as the balance sheet runoff continues, The expectation is that those ONRRP balances will come down, and then reserves will come down, one for one with the runoff of the securities on our balance sheet. We want to basically run an ample reserve regime. Okay, ample reserves means that the reserves level are ample enough that we control the Fed funds rate using administered rates, the primary credit rate, the interest rate on bank reserves, and the interest rate offered on overnight RRPs. So we want that framework to work. If reserves fall too low, that will have some of the stresses that we saw back in September 2019. So we want to avoid that. So we want to sort of stop the runoff, right, at a point where we're at, have a cushion above ample, and then allow the balance sheet to organically come down and then grow again. So the idea is if we slow the runoff, right, there's more likelihood we won't get into a September 2019 situation, and perhaps have to, stop the runoff and actually have to build reserves back up, right, prematurely if we hadn't reduced the pace. So that's what we're talking about now. I'd be very comfortable with starting that very soon in terms of reducing the pace. That would have no implications for the ultimate size of the balance sheet. So slowing runoff doesn't mean that we've decided that somehow we want the balance sheet larger than we thought before we slowed the runoff. It really is a way of managing sort of the glide path to that point of ample reserves where we actually stop the runoff. And so that's what the discussion is about, is, what do we need? And what we're doing is, of course, is monitoring a lot of statistics. The Open Market Desk in New York publishes and monitors a lot of statistics that tell us about the strength of demand for reserves, the distribution of reserves, and really these price indicators that can tell us whether we're getting, to the point where there's some of this sort of a little bit more demand for reserves versus supply reserves. So we kind of want to monitor all that, and that'll give us a good indication of when we want to really stop the runoff and allow the balance sheet to sort of continue to run down. So that's kind of what the discussion's about. I'm just speaking for myself. I'd be very comfortable with slowing the runoff now, very soon. But that'll be a committee decision to be made over, the next meetings in our meeting. So.
Transitioning back to our previous conversation, but in a slightly different direction, the most recent summary of economic projections, the dot plot, showed 3 rate cuts for 2024. And do you think that the dot plot remains a useful communication tool for the Fed? And how might you like to see it improved going forward?
Yeah, so I'm a fan of the dot plot. I know not everyone is, but I am. I think it provides good information on where the individual participants on the committee are. And I really think it's very important for the Fed officials to really, explain their policy views. And the dot plot and our forecasts and speaking like today's conversation is a way for us to really tell the public kind of what our thinking is. I think there's some misunderstanding of what the dot plot is sometimes, like it's the policy path that the Fed is committed to. No, it's not at all. And as you look at the plot, that there's different views on the committee, of course, of what the appropriate policy path is. But I do think it gives you good information about where the center of the committee is, and that's that median. What's the median path, which is your three cuts this year is the median expectation. But also it's helpful to look at how those dot plots and the whole forecast change over time, because that can tell you something about how the committee incorporated data. So if you look at the last set of projections, right, you'll see that real GDP growth was revised up in many of the participants' forecasts, and also in the median across participants. Well, that was really an indication that we took on board the data that had come in showing that the economy had more resilience than we anticipated. So I revised up my forecast, again, rather than thinking that growth would be a little bit below, trend this year. I'm now a little bit above trend. And similarly, other people took the data that came in and may perhaps revise their forecast. So I think the dot plot and the whole SEP, which is a summary of economic projections, tells the public information that I think is useful for them to understand sort of our views on the economy, and therefore, hopefully, our views on sort of appropriate monetary policy. I think there can be many improvements in our communications and transparency. And of course, the Fed's been on a journey towards more transparency for quite some time. One thing about the forecast we do is it really focuses on the most likely scenario. We don't really give that much information about alternatives. That's something we could work on. We do talk about the balance of risk and the level of uncertainty, but there's improvements there. And similarly with other communications that we do in terms of, the statements can be pretty sparse in terms of explaining the outlook. So I think there are improvements we can make to our communications, but the bottom line is we want people to understand where our expectations for the economy are, what the risks around that outlook are, and then how does that outlook translate into what we anticipate will be appropriate monetary policy. And I think that's the challenge for any central bank, is to explain those views to the public. And it's also our responsibility to explain those views.
So with the 15 minutes we have left, thank you so much for your time. I wanted to go through some of the questions that we received before, and also those questions that have been submitted during our discussion. If you have questions for those live participating, please submit them in the Q&A box. The first question, because it's in line with what you were just talking about, that there appears to be increasingly divergent views on the path of rate cuts among FOMC members. Could you please comment on just the diverging path and what your thoughts are on that?
Well, I think it's a real indication that, right, there are different views of the economy and different views of the balance of risk, right? So, different people on the committee, different participants may have different views about, what they think is going to happen in the economy going forward, and may have different views about how much more evidence they need about inflation before they're prepared to lower the interest rate. I think one thing that happened between the December summary of economic projections and the March ones that just came out a couple weeks ago was that you saw that, the balance of the committee, even though they both had 3 rate cuts this year as the median among the committees, you did see there was a shift a little bit towards people who thought maybe 2 more appropriate. And that was a reflection of the data that came in, right? The data came in a little firmer on inflation in January and February. And so the committee does take on board data. And so it's a good indication of sort of an illustration of data dependence, if you will. So the strength of the committee really is the fact that we might have different views about the economy. We may have different views about appropriate policy. We bring them to the table. We talk about those views. I learn from other participants, when I hear what they see out in their regions, right, and their take on data, national data that's the same, right? They may have a different, interpretation of what the meaning of that is for the go forward. So again, we come in with our own personal views about the economy and our models, our own information about our regions, and we sit around the table and have a very good discussion. And then we usually come to a consensus about what does this mean for policy, and then we move forward. Not to say there's never a dissent, because we know there are, but we're working towards coming up with what we think is appropriate. And a lot of that is about balancing the risks, right? We want to be in I think here, right, I feel good that I think policy is well positioned, right? Whichever way the risks end up falling, right? I think the real challenge and the issue that we had when we began raising rates was that policy was not well positioned. And I think that we had to then take very aggressive actions. And of course, that was, not something I would aspire to doing. But, we had to do it then, and now we're better positioned. So I think that's going to be the challenge going forward. And I think that, having, showing the public that there is a difference of views, but also explaining the consensus view, explaining as the chair does in the press conference, here's a sense of our view as a committee on where the economy is, where it's likely to go, what are the risks around that likely path, and what are the implications for monetary policy. I think that's very important too. So it's not only just putting out, oh, everyone has a different view. It's really, okay, what is the consensus view and what does that mean for policy?
That makes sense. Another question that you talked about earlier in the conversation, but I think it's helpful to kind of go over it again. Where do you see the main sticking points or maybe the areas of concern in the basket of goods and services and trying to achieve that 2% target?
Well, services, core services, so take out food and energy, which we know are usually typically volatile. Not that we ignore them because that's a big part of the consumption basket, but in terms of thinking about where inflation's going, that tends to be sticky. And it has been this time. It's above, our goal, certainly. Housing, we've been seeing this decline in rents and new leases for a while. Haven't seen as much decline in house services prices. We're anticipating it. We have seen some, but it's sort of more stable now. So again, we're going to have to really be careful looking at those. And core goods prices are still falling, but not at the same pace they were falling before. So again, I think we're going to have to see progress across the board in order to really get that confidence that inflation is on that path and it's sustainably down to 2%. So again, it's monitoring all of that and not one particular area. I think all of it. And there's other risks to the forecast. We know oil prices have gone up. There's geopolitical risks. There's a lot of unrest in various parts of the world. And so we just have to keep monitoring those risks as well, and monitoring the economy so that we can do this careful calibration of our policy in order to achieve both parts of our mandate going forward.
On a totally different path, but I think a lot of folks are concerned about the impact of the federal debt or deficits or yearly deficits. And, with understanding that, not talking too in-depthly about, what you would suggest on these fronts, but, what the ability of the Fed to achieve its inflation goals with these concerns and significant concerns related to the federal debt and deficit levels.
Yeah, I do think it would be important for the economy and for the country to get our fiscal situation on a more sustainable path. It's not right now on a sustainable path. I think everybody knows that. And it's going to take a comprehensive plan to be able to achieve that. So I think that is a risk. It's whenever you talk about the fiscal side of things, there's always like, well, it hasn't happened yet. And we've seen high debt levels and high deficits before, but there is a point where it will have an impact. And we need to be able to have that plan and get back on a sustainable path before that crisis, potential, disruption occurs. So again, I do think that this is something that's important for the country.
Looking at another question that was submitted, what metrics, we've heard a lot about everybody's kind of estimate or predictions on soft landing. What metrics would you be looking at to assess whether the US has achieved a soft landing, or what your definition of a soft landing would be?
Basically, I would like to make sure our policy is calibrated so that we do get inflation back to our 2% goal over time and maintain healthy labor markets. To me, that's kind of the definition of soft landing, is that we want that to happen. And so, that's kind of both sides of our mandate taking into account. And I think that's kind of, to me, that's what I would say is what we're trying to achieve. And certainly when I'm thinking about policy setting, that's what I'm trying to balance those risks to both sides of our mandate and also the risks around the outlook. That's certainly what I have in mind. Right? Inflation sustainably on a sustainable path down to 2%, so we achieve that and get back to price stability while we're maintaining, healthy labor market conditions.
So there are a few questions related to oil prices, and you had mentioned that before as being one of the risks of, global risks that impact impact inflation here. How much of that is of concern when thinking about rate cuts going forward and the risk in higher oil prices and energy costs?
I mean, we're not as tied to oil as we used to be, right? It would have a bigger impact on the economy. In fact, we're exporters now instead of importers. But the mechanism through which it would concern me is if we do see a rise in inflation expectations because we see oil, energy prices, and in particular gasoline prices move up. Because what we know from the survey work that we do here, we have a Center for Inflation Research here at the Cleveland Fed, and we've done a lot of work on inflation and inflation expectations, which are actually an important determinant of actual inflation and where inflation is going. If inflation expectations start moving up again, that would be a concern. And gasoline prices have a important effect on people's feelings about where inflation is going. And so I think that would be the mechanism. So I do look at inflation expectations quite a bit because that really informs my outlook for inflation. And so far, even though we had those very high inflation rates, between 7 and 9% peaks, depending on how you measure it, longer run inflation expectations were fairly well anchored over that period. Short run expectations, like a year out, they did move up quite a bit, but they're moving down. And so that is also giving me more confidence, right, that we will get inflation back down to 2%. If I saw those expectations starting to move up, then that would give me pause, and that would be a concern. So far, we haven't seen that, but that's the kind of mechanism that I would be most concerned about.
One question that just came in, and it's related to Baltimore and the bridge collapse and how that impacts your view of the economy going forward. How significant are you anticipating that being for the U.S. economy more generally?
So I grew up in Baltimore. I remember when that bridge was built, so it was very sad all around for a lot of people, and a tragedy, really. So far, we had as I mentioned, a business advisory council meeting, and that was one of the questions we asked: has it impacted your businesses so far? And I think every participant said that it hasn't had an impact so far. Some said maybe it's too soon, right? They expect that, some goods will be diverted from the Port of Baltimore to other ports, partly because of that collapse. And so we may see that impacting supply chains and, maybe delays. But right now, we don't have an estimate that it'll be a big impact. We're just going to continue monitoring it and asking our contacts about whether that has had an impact on their supplies and in what way it's affecting their supply chains. So far, it hasn't. And most estimates are that it won't have a huge effect, but it will have a huge effect on the region there. So that's something that, we're going to be watching carefully.
Great. Well, our time is up. Thank you so much for spending this time with the GIC community. And as a reminder to our audience, before we close, GIC will have this webinar on archive, so you can watch it if you missed parts of it or want to rewatch it again on the website. And we have some great in-person programming coming up. But I did want to let everybody know that the in-person programming, and I apologize that trying to find where, I know being the vice president of programming, but we do have a few on June 17th, hosting the 42nd Annual Monetary and Trade Conference in Philadelphia, featuring Patrick Harker, president of the Federal Reserve Bank in Philadelphia. And then also the June 28th GIC returns to Paris to partner with the Banque de France for our Central Banking Series event, featuring Tom Barkin, president of the Federal Reserve Bank in Richmond. And then also, following that, July 10th, the GIC Teton Economic Outlook takes place in Jackson Hole, Wyoming. For event registration or to explore GIC membership, please visit our website at interdependence.org. Thank you so much for your attention, and have a good day, everybody.